Welcome, everyone. I'm excited to kick off today's session with a focus on financial literacy. Today's presentation is titled, A Smart Relationship with Money. We'll explore how understanding and managing our finances wisely can lead to better outcomes and more confidence. Over the next few slides, we'll cover key concepts, practical tips, and strategies to help you develop that smart relationship with money. So let's get started. Let's take a closer look at some key aspects of financial literacy that are essential for building a solid financial foundation. First, we have wealth building, which is about growing your assets over time through smart investments and disciplined saving. Risk management is equally important. It involves understanding and mitigating potential financial risks to protect your wealth. Budget planning helps you allocate your resources effectively, ensuring you're living within your means while saving for the future. Market trends are another critical factor. They influence investment decisions and help you stay ahead of economic shifts. Setting long-term goals keeps you focused and motivated, guiding your financial journey. Diversification strategies are vital because they help spread risk across different assets, reducing the impact of any one investment's poor performance. Lastly, tax planning is about making informed decisions to minimize taxes legally, thereby maximizing your after-tax returns. All these components are interconnected and contribute to a comprehensive approach to managing your finances wisely, aligning with the overall goal of achieving financial stability and growth. Let's take a closer look at some key concepts related to financial literacy, especially around tax savings. When we talk about tax savings, we're essentially looking at ways to reduce the amount of tax we pay legally. One important aspect is income tax filing. Properly filing your income taxes can help you identify deductions and credits you're eligible for, which ultimately can lower your tax bill. Next, we have capital gains tax. This is the tax you pay on the profit you make from selling assets like property or investments. Understanding how capital gains tax works can help you plan your investments better and possibly minimize the tax payable on those gains. Then there's the net consideration deposited in the bank. This is the amount you actually receive after all taxes are deducted from your investment or sale proceeds. It's crucial to know this because it reflects your real earnings after tax obligations. Connecting these points to the overall theme, mastering these aspects of financial literacy empowers you to make smarter financial decisions, optimize your savings, and ensure you're making the most of your money while staying compliant with tax laws. Let's talk about the capital gains account scheme, which was introduced back in 1988 by the central government. The main idea behind this scheme is to encourage individuals to reinvest the gains they make from selling capital assets. Now, when you sell an asset and make a profit, that profit is called a capital gain. Instead of paying taxes immediately on that gain, this scheme offers an opportunity to reinvest it and get some tax benefits. If you reinvest your capital gains into specific assets within a certain time frame, you become eligible for exemptions from capital gains tax. This is outlined under sections 54 to 54 GB of the Income Tax Act. The goal here is to promote reinvestment, which can help stimulate growth in certain sectors of the economy. So, the key takeaway is that this scheme is designed to reward investors who choose to reinvest their gains, making it a very important tool for tax planning and investment strategy. It connects directly to our broader theme of financial literacy by showing how understanding and utilizing such schemes can help you manage your taxes effectively while growing your wealth. Let's take a closer look at who can deposit in the Capital Gains Account Scheme, or CGAS, and the specific categories of taxpayers who are eligible. As per the Income Tax Act, 1961, Sections 54 to 54F, different types of capital gains have different eligibility criteria. For example, under Section 54, if you've sold a residential house, then individuals or Hindu undivided families, HUFs, are eligible to invest in CGAS. Similarly, Section 54B covers the sale of land used for agricultural purposes, again open to individuals and HUFs. Section 54D is a bit broader, applying to any taxpayer who faces a compulsory acquisition of land or buildings. This means if the government acquires your property, you can still benefit from CGAS. Section 54E deals with the sale of any long-term capital asset. This is quite inclusive and applies to all taxpayers, regardless of the asset type. Moving on, Section 54EC pertains specifically to the sale of long-term capital assets like land or buildings. But again, it's open to any taxpayer. Finally, Section 54F is interesting because it applies to the sale of any long-term capital asset that is not residential property. Here, only individuals and HUFs are eligible. So, the key takeaway is that depending on the type of capital gain and the asset involved, different categories of taxpayers, mainly individuals and HUFs, are eligible to deposit in CGAS. Recognizing these specific sections helps us understand who can make use of this scheme and plan accordingly. Now, let's take a look at who can deposit in the Capital Gains Account Scheme, or CGAS. This scheme is designed for certain categories of taxpayers who are making capital gains and want to save on taxes by investing in specified ways. Specifically, under Sections 54 to 54F of the Income Tax Act, 1961, the eligible taxpayers are those who have made capital gains from particular types of transfers. For example, Section 54G applies when there's a transfer of assets like machinery, plants, buildings, land, or rights in land or buildings, due to the shifting of an industrial undertaking from an urban area. Basically, if a business moves out of a city to another location, the taxpayer can benefit here. Similarly, Section 54GA covers cases where the transfer involves assets like machinery, plants, or buildings, but specifically when the move is from an urban area to a special economic zone, or SEZ. Again, this is aimed at promoting industrial development in designated zones. Then there's Section 54GB, which is focused on residential property transfers. If a taxpayer sells a residential property, they may also be eligible to deposit in the CGAS, provided they meet certain conditions. So the key takeaway here is that the scheme is accessible to a broad range of taxpayers, anyone who is transferring these specified assets under the conditions outlined in these sections. This allows them to manage their capital gains more effectively and potentially defer taxes, which ties into our overall theme of intelligent tax planning and investment. Let's talk about opening a capital gains account, or CGA, which is an important step in managing your investment profits. You can open this account at any authorized bank branch, but it's important to note that rural branches of these authorized banks are not included. So, you'll want to choose an urban or semi-urban branch. Now, where should you actually open your CGA? In India, only certain banks are authorized to do this. Some of the key banks include the State Bank of India, IDBI Bank Limited, the Central Bank of India, and Bank of Baroda. These banks are recognized by the government and are authorized to open and manage your capital gains accounts. This process is straightforward, but it's crucial because having a proper CGA helps you efficiently manage your capital gains, especially when dealing with mutual funds or other investments. Always remember to check with your bank if they're authorized before proceeding. And for more information, you can visit the website mentioned here, www.realegratesite.com, which offers additional guidance on financial literacy and investment procedures. Now, let's take a look at the different types of deposits available under the Capital Gains Account Scheme. First, we have Type B, the term deposit. This is quite similar to a fixed deposit account that you might have with a bank. It earns interest at a rate applicable to term deposits, and it comes with restrictions similar to those of a fixed deposit. The maximum duration for a Type B account is 3 years. When opening this account, you'll need to choose a term based on your specific investment plans, such as 2 years if you're planning to buy a new house, or 3 years if you're planning to construct one. This helps align your investment with your financial goals. Next, let's talk about Type A, the savings deposit. This is quite similar to a regular savings bank account. It earns interest at a rate comparable to standard savings accounts, and interest is credited periodically. Plus, a passbook is issued to keep track of your transactions, making it easy to monitor your savings. One of the key advantages of a Type A account is its liquidity. Just like a regular savings account, you can withdraw money at any time without any restrictions. This flexibility makes it a convenient option if you want easier access to your funds. Connecting these points to the overall theme, understanding these deposit types helps us make informed decisions about how to best utilize our savings and investments under the capital gains account scheme. Whether you prefer the fixed, disciplined approach of a term deposit or the flexibility of a savings account, knowing your options is essential for effective financial planning. Now, let's take a closer look at the section on capital gain bonds. These bonds are a useful tool for saving tax, especially if you've recently sold an asset and want to reinvest the gains. By investing in capital gains bonds under Section 54 EC of the Income Tax Act 1969, you can defer paying taxes on your capital gains, provided you invest within 6 months of the sale. The maximum amount you can invest is 50 lakh rupees. It's important to note that these bonds are non-transferable and non-negotiable, meaning you can't sell or offer them as security for loans. They have a maturity period of 5 years, and premature redemption isn't allowed, so you need to plan accordingly. At maturity, the returns are tax-free, which is a major benefit. The bonds are issued by IRFC and REC, both of which are highly stable and rated AAA, giving you confidence in their safety. The current rate of interest is 5.25%, locked in for the 5-year period. However, remember that interest earned on these bonds is taxable according to income tax rules. Overall, capital gain bonds are an attractive investment option if you're looking to save on taxes while earning stable returns over the medium term. Let's take a closer look at Wardier, Inc.'s investment and financial options. On this slide, we compare two investment strategies, investing in 54 EC bonds versus investing in a fixed deposit with quarterly interest payments. First, both options are based on a property sale with a sales value of 1 crore rupees and a capital gain of 50 lakh rupees. When we consider the tax implications, investing in 54 EC bonds allows us to save on long-term capital gains tax, which is normally 12.5% plus cess. In this case, there's no LTCG tax paid if we go the 54 EC route, whereas investing in a fixed deposit results in a tax liability of 6,50,000 rupees. Now, looking at the amounts available for investment, we see that with the 54 EC bonds, you can invest the full 50 lakh rupees, while with the fixed deposit, the amount reduces to 39,50,000 rupees after tax. Next, let's examine the interest rates. The bonds offer a rate of 5.25% per annum, leading to an interest income of about 13,12,500 rupees over 5 years. The fixed deposit, on the other hand, offers a higher rate of 7%, resulting in roughly 18,04,285 rupees. However, after accounting for tax on interest income, at a rate of around 31.2%, the net interest income drops to approximately 9,03,000 rupees with bonds and 12,41,348 rupees with fixed deposits. When we add the initial investment to the interest earned, the maturity value totals about 59,03,000 rupees for bonds and 55,91,348 rupees for fixed deposits. Another key benefit of the 54 EC bonds is the LTCG tax saved, which amounts to 6,50,000 rupees, adding to the overall benefit. When we combine the net interest income with this tax saving, the total benefits come to around 15,53,000 rupees for bonds versus about 12,41,348 rupees for fixed deposits. Finally, if we look at the overall return on investment, the bonds provide approximately 31%, while the fixed deposit yields about 28.5%. This comparison clearly highlights how strategic investments, like 54 EC bonds, not only help save taxes, but also offer competitive returns, aligning with our overall theme of optimizing financial planning. Wardiere, Inc. introduces a financial literacy scheme designed by PFRDA to promote income security for old age. This scheme is open to residents, non-residents, and OCIs between the ages of 18 and 70 years. One of the key points is that an account can be opened by either an individual or a corporate entity, making it flexible for different types of subscribers. When you open an account, you'll receive a unique 12-digit number called the Permanent Retirement Account Number, or PRAN. This number is essential because it uniquely identifies your account and helps in managing your retirement savings efficiently. Under the NPS account, there are two sub-accounts, Tier I and Tier II. Tier I is mandatory, meaning all subscribers must have this account, which primarily focuses on retirement savings. The subscriber also has the option to open a Tier II account if they wish, which provides additional flexibility for savings that are more accessible. Overall, this scheme aims to encourage long-term savings for old age, and understanding these key features helps us appreciate how it supports financial security in later years. Let's talk about financial literacy, which is such a crucial skill for everyone. When we understand how money works, things like budgeting, saving, investing, it really empowers us to make smarter decisions. And that's exactly what this slide is about. For more resources and insights, you can visit www.realegratesite.com. Now, I want to highlight the unique features of this site because it offers tools and tips tailored to different learning styles, making financial education more accessible and engaging for everyone. Remember, improving financial literacy isn't just about numbers. It's about gaining confidence and control over your financial future. So, as we move forward in this presentation, keep in mind how these resources can play a key role in your financial journey. On this slide, we're looking at how the funds for financial literacy are invested across 4 different asset classes. The key point here is that each class has a specific cap on how much can be invested, which helps manage risk and diversify the portfolio. Starting with equity, or what we call E, the cap is 75%, but only up to age 50. This means younger investors can have a larger proportion in stocks, but as you approach 50, the allocation might need to be adjusted. Next, we have corporate bonds, labeled C, which can go up to 100%. This gives flexibility to invest heavily in bonds if the investor prefers a more conservative approach without a set cap. Government securities, G, also allow up to 100% investment, providing a safe avenue, especially as investors get older or seek stability. Then there's the Alternative Investment Fund, A, which is limited to 5%. This allows for some exposure to potentially higher return, less traditional assets, but in a very controlled manner. The slide also introduces 2 important options, active choice and auto choice. Active choice means the investor or advisor actively selects the asset allocations, tailoring the investment to specific needs. Auto choice, on the other hand, automatically adjusts the allocations based on the investor's age, helping to simplify the process and ensure appropriate risk levels. Looking at the age-based table, you can see how the portfolio shifts over time. For example, up to age 35, the allocation favors equity at 50%, with smaller portions in bonds and government securities. As you grow older, the equity share gradually decreases, and the portion in government securities increases significantly, up to 80% after age 55, reflecting a more conservative, stable approach as retirement approaches. Overall, the goal here is to balance growth and safety, adapting the investment mix to your age and risk tolerance, whether you choose active management or an automatic adjustment. Welcome to slide 14. Here, we see the logo of Wardiere, Inc., a company focused on investment and financial services. Their website, realegratesite.com, is also displayed for more information. Moving on, we see the section about an emergency fund. This is a crucial concept. Having a safety net for unexpected expenses provides financial security and peace of mind. The placeholder text here emphasizes the importance of building and maintaining such a fund, especially in uncertain times. Next, we have the financial literacy segment. This is about empowering individuals through knowledge, understanding how money works, managing budgets, and making informed financial decisions. The mention of the Stand Up India initiative highlights a significant government program aimed at supporting SC, SD, and women entrepreneurs. This scheme isn't just about providing loans. It's about creating opportunities, inspiring change, and turning dreams into realities. Overall, this slide ties into the broader theme of financial empowerment, equipping people with the tools and support they need to succeed financially. Building an emergency fund and increasing financial literacy are key steps in achieving that goal. Let's go through the key eligibility criteria and loan details for this scheme. First, to qualify, the applicant should be an SC, SD, or a women entrepreneur who is above 18 years of age. It's also important to note that the borrower should not be a defaulter with any bank or financial institution, ensuring they have a good credit standing. Moving on to the nature of the loan, this is a composite loan ranging from Rs. 10 lakh up to Rs. 1 crore, and it's provided through scheduled commercial banks. The main purpose of this loan is to help set up a new enterprise, whether in manufacturing, services, agriculture-allied activities, or trading, specifically by SC, SD, or women entrepreneurs. Regarding repayment, the loan is designed to be repaid within a period of 7 years, and there is a moratorium period of up to 18 months, giving the borrower some breathing space at the start. For working capital, if you need up to Rs. 10 lakh, you can opt for an overdraft facility linked with a RuPay debit card. For amounts above Rs. 10 lakh, a cash credit limit will be provided to meet your working capital needs. Now, let's talk about the margin money. You can contribute up to 15% of the project cost, supported by central or state schemes, which can significantly reduce your upfront investment. Additionally, at least 10% of the total project cost must be contributed by the borrower as their own contribution, ensuring commitment and ownership of the project. Overall, this scheme aims to empower SC, SD, and women entrepreneurs by providing accessible financial support, with flexible repayment options and a focus on encouraging entrepreneurship in various sectors. Now, let's look at the growth under the Stand Up India scheme between 2018 and 2024. First, the SC accounts, which are the scheduled caste accounts, increased significantly from 9,399 to 46,248. That's more than a fourfold increase, indicating a strong push towards financial inclusion for marginalized communities. Similarly, the scheduled tribe or SD accounts grew from 2,841 to 15,228, showcasing progress in empowering tribal entrepreneurs. And when it comes to women entrepreneurs, the accounts surged from 55,644 to an impressive 190,844. This demonstrates a clear focus on promoting women-led businesses and fostering gender equality in entrepreneurship. Overall, these numbers highlight how targeted schemes like Stand Up India are making a tangible impact by expanding access to financial resources. And of course, this growth is closely tied to increased financial literacy, which remains a key component of our overall strategy. By empowering these groups with both access and knowledge, we're fostering sustainable development and inclusive growth across the country. Thank you,